So taking the previous discussion upon the price to earning multiple forward, we need to understand that whenever we're trying to forecast the company's forward price to earning multiple, a forward price to earning multiple always has a DCF embedded into it. Here we need to understand that how this Gordon model can affect the company's price to earning multiple. The Gordon model simply helps us to ascertain the company's intrinsic value or the intrinsic price of a share. We tend to divide the company's future free cash flows, expected future free cash flows, by the spread of the cost of capital and the growth rate. If the spread of the cost of capital and the growth rate compresses, it means that the future free cash flows are getting discounted by a lower cost of capital. Hence, the price to earning multiple tends to get expanded. And the vice versa is also true. When this spread of the cost of capital and the growth rate tends to get widened, and the future free cash flows, they tend to get discounted by a higher cost of capital, and the valuation multiples tend to get compressed. Also here, we need to understand the trade-off of the free cash flows to the firm in the numerator and the growth rate. This growth rate is something which is calculated by using the reinvestment rate. The reinvestment rate into the return on invested capital. That is, how much capital we are pouring back into the business for growth, expansionary opportunities, and at what rate. If the reinvestment rate is higher, the free cash flows available to the firm might be less, and this growth rate might be high, because we are reinvesting what we are making in terms of cash flows back in the business for growth and prosperity. In this case, the free cash flows might be a lower number and the growth rate will be a higher number. Hence, the spread between the cost of capital and the growth rate will tend to get compressed, and the valuation will be a higher number. The price to earning multiple will expand. In the other scenario, when the company is not reinvesting, or the company has been investing less as a part of growth and prosperity, in that case, the free cash flows to the firm in the numerator might be a higher number, and its G component, which is a product of the reinvestment rate and the ROIC, will be a smaller number. In that case, the spread between the cost of capital and the growth rate will become a higher number, and the future free cash flows will get discounted by a higher cost of capital. In that case, the price to earning multiple might get compressed. And here it's important to understand the spread, the reinvestment rate, and the relationship of the price to earning multiple with the Gordon model, which helps us to ascertain a company's intrinsic value.